Now, why does this matter? Why should we care about this? Credit provision for people is a major topic. So let's look a little bit about demographics and some of the data that exists. So first of all, this is US data, is most of the credit of these lenders go into the area of unsecured loan, right? So this is really where fintech lending goes in. And this is where, you remember this graph that I plotted before, these are, the loans that are easy to get. Easy to get usually means you don't have to post any form of collateral. Now, much of these unsecured loans, what they do is they finance some form of purchase volume. There could be store purchases, clothing and so on and so forth, usually some temporary payments or maybe a bigger payments, but it's you can buy a computer or the like. But it's really just, retail consumer purchases. That is the major part about this. Now, debt generally has actually fallen, in terms of what people do in terms of their spending, from roughly 65% in 1996 to only 27% roughly in 2018. So the balances, if you want, are at the end we're accounting up to, and this is purchase balance, is about $900 billion. Whereas the overall credit lines are on the order of 4.3 trillion. And this is for those that have an annual percentage rate of over 20%, so typically credit cards and store cards and so on. Now, if you look at the amount for people, how people use it, is about 60% of people pay their balance in full, for credit cards, for instance, and 40% keep a balance and do not. So, and this is important to keep in mind, this is for loans which have an interest rate of over 20%. So people will take out loans that have really high interest rates, and yet they don't pay them off right away. So let's look at the data. Now, this is an interesting graph here because it basically plots the usage of cards and then what portion and what amount of those is actually carried over, as in which people carry as a balance. And you see the top line here is the one which is the purchase volume. And so now what we observe is that the amount of purchase volume used by credit cards in particular has been going up and up and up, whereas the amount of balance that people have on the credit card has not gone up. So in other words, people use their credit cards to pay for things, but it doesn't mean that they expand the credit. So that's important to know because it means essentially that credit cards don't expand the amount of credit in an economy. Instead, what it does really is it's a different means of payment. And that, we will talk about payments in a separate set of this class too. So bottom line here is, yes, they are used more, but it's not an expansion of credits as such. However, if we look at private label cards, so this is important, things look slightly different. So private label card is something like store cards that used to purchases made for a dedicated store or network usually. So think about it as your Canadian Tire card. Most stores in some form offer a credit card for their own, bigger stores, or bigger store chains offer their own credit cards. And really what that is meant to do is not so much for people to use this as a credit card, but it's really for them to use it in their particular store to make usually a major purchase. And for those, people actually keep a balance. So you can see here the green line is the balance that people keep, and you can see how that one has been going up over time. So in other words, people use these cards for specific purposes. All right, now let's look at a little bit about who gets what. Now, it's important that you understand how credit normally works. So normally people are, whether or not they receive credit depends on the credit score. You all have a credit score. Well, actually that's not true. Many of you have some form of credit score. Every time you had a credit card or anything means that you have a credit history, which means you have created a credit score. And there are various different categories here, which I list here in this table. So we go from super prime to near prime, and then we go to subprime, deep subprime, and essentially non-existing credit score, so invisible or very thin, right? Now, super prime are people who have a high score, which are, who are very secure, and the same holds for the prime. So those together account for about 54% of the US population. Then you have the near prime and subprime and deep subprime, and everybody else below that accounts for, so these are people who are more risky in terms of obtaining a loan, as in for the lender, they're more risky. So now this gives you, the first column gives you the distribution on the US population. Then you can see about 22% here have have no credit file essentially. So these are people who are effectively unbanked. It's a huge population in the US. The numbers, I don't have the same numbers for Canada. Canadians say essentially, the Canadian Bankers Association say 96% of people in Canada, or actually no, they say 99% of people have a bank account. I find that a very high number. I think this is a bit of an exaggeration, right? So because the people on the street and people in northern communities where there is no bank, I can't see how they could possibly have a bank account. But here we are. You can also see that there's people who are deep subprime, so they have very, very low credit scores. So something below 620, and that's already a very low score. And that again accounts for about 13% of the population. Now, if you look at the scoring distribution, you see that the ones with the thin files simply don't show up. Right, so of the score population, of course, then there's an overrepresentation of the super prime people and the prime people, right? And then some of it, is the deep subprime are also higher scored. Now then, who receives the loans? You can see, and this is the last column here, you see most of the loans go to people who are prime or super prime, whereas people who are in the lower part and deep subprime, in particular deep subprime people, they receive less than half of their loan applications, or when they get scored, they receive less than half of the loans that they ask for. So in other words, for people at the very low end of the population, it's actually very hard to get a loan. Now let's look at the credit cards, for instance. What we see is, if you look at the number of consumers that have these cards, we see that people who are in the super prime and prime category, almost everybody has some form of credit card available to them. And if you go down to, subprime and deep subprime, only a very small number of people have access to these credit cards. Now, this is important later on when we talk about, issues such as credit card payments, because you can see that people who are in the deep subprime and the subprime part of the population, they can't easily shop online because you usually need some form of payment card to be doing online shopping. So you can see that there is already a problem there. Right? So it's a question of equality and so on and so forth. But you can see that notwithstanding, about 70% of the population has roughly a credit card. Now, if you look at the approval rates, you can see, of course, the approval rate for people who have super prime and prime loans, they have a very high approval rating, something on the order of 80% for people who are super prime. It's still over 60% of people who are prime. But if you go to the subprime and to the no score people, their acceptance probability is under 20%. So not only do we have bad credit score, but it's actually difficult for you to get a credit card, which means it's difficult for you actually to obtain a credit score, because without having a banking products, you can't establish a credit history and you can't get a score. Now, there's also a question of how are these results used. So there's a question of what is the usage of the credit line that you obtain. And you can see people in the super prime area, they use only about 30% of their borrowing capacity and keep a balance on it. Right? So in other words, people who have already a high credit rating are also the ones that pay off their loans. Prime people, they're more likely to keep a balance, but they're still able, it's about 65% or so, 35% pay it off in full. So in other words, the vast majority of the population, as you can remember, these guys together account for the vast portion of people that actually do get these loans. They pay everything off. Whereas people who are at the lower end of the spectrum, they actually use the credit cards and they keep a balance on this. So not only is it hard for people to actually obtain a loan, they also carry a balance on which they pay enormous fees. Now, coming to the fees, and this is also important, now, for credit cards, there's more than just the APR that you pay, the interest that you pay on your loan. There's actually a lot of fees involved. So, for instance, if you try to make a purchase and you go over your limit, you have to pay a fee. If you don't make your minimum payments, you have to pay a fee. All of this is what you see here is the shaded area are the parts where there is of the payments, general payments that you make. It describes the portion which is due to fees that you make. And you can see the guys that are using the loans, and that have enormous payments that they have to make because of the high interest rates, they also pay a lot of fees. So a very large portion of what it is that they pay is part of the fees that they pay. Whereas people who are in a good financial situation, they barely ever pay any fees. So this is now, why am I bringing this up? I'm bringing this up because people have a hard time getting a loan. When they have a loan, they have to pay a lot of interest, and then they often have to pay fees on top of that. So, for them, a credit card is possibly, let's say, financially dangerous. Now, if you look at the delinquency labels and the loans, again, you see that private label credit cards also have a much higher rate of delinquency. So, and this is where it gets tricky, right? So they give out these cards to people for particular purchases in their store. People keep a balance, and then they're also delinquent more likely on it. So, that is a very strange area where people get really very expensive loans, let's say. Now, the question is, okay, so there is an existing market for these credit cards and all that. And so then you ask yourself the question of, well, is this a market which could be disrupted, right? So now we know credit card loans, people are delinquent on it, and there's a higher risk therefore associated with it. But you also receive quite high payoffs from that, both from fees and from the interest rates. Now, if we just look at the market as a whole, without even looking at the deep subprime area and so on, the average that you earn per customer is something like 13 to 15% here. So this is just your income. Now, the average losses that you get are on the order of 2 to 4%. So in other words, the return on this portfolio, on this credit portfolio, is on the order of 9 to 13%. That's quite sizable, right? And so it's also probably because it's quite diversified, it's also something where you can, probably diversify your risk well. So now this is a large rate of return. So this is an area where you can easily imagine that disruption is possible, because whenever there is high rents to be made, there's room for incumbents to come in. So let's start with a simple fact, right? So for instance, in credit cards, almost everybody gets offered the same APR, right? So there is not a lot of risk-based differentiation. Although, forgetting about the part about the credit scoring, even among those, not everybody is equally risky, right? So there is a possibility to improve there. Now, the problem, of course, is that the alternative loans, right? So personal loans or any kind of unsecured loans, are actually quite hard for people to get. But this is precisely where the fintech lenders go. So now, if you look at this is a general part about what debt balances people have, and you can see mortgage debt accounts for the largest part of the total debt balance of the population. And you can see this little red line here, it's relevant for you. This is for student loans, and you can see how that actually has gone up quite a bit over the last few years. Now, keep in mind, this is the US, it's not Canada. So I don't know the details of that data, but if you compare the data from, the early 2000s, right? So student loans made up a much smaller portion, and they make up a huge portion now. So in some US schools, the overall education costs you on the order of $300,000 just to get your bachelor's degree. Anyway, so now, speaking of student loans, this is actually a very low-hanging fruit. So the point is that oftentimes all students within the same cohort get the same interest rate, right? So, there is ways, or that you could easily imagine ways of how you should go after the graduates that are more likely to succeed, and you do some cream skimming there. And in fact, there is actually, there's a fintech lender, it's called Sophie, right? So where you can save money on your student loan. So if you pick, for instance, a subject such as engineering, computer science, possibly also commerce, where you're more likely to get profitable employment after graduation, then you may be able to get better loans on your student loans, right? Because it's more likely that you have profitable employment afterwards. And if you have that, then you're more likely to repay your loan. And so that reduces the risk for the lender, and therefore you are offered a better rate. There's also, so here's what the founder says, right? So, one of the ways you can do this is also by getting something like home equity loans, right? So home equity loans are actually hard to get, right? It can take 30 to 45 days to get a line of credit on your home. Now, the idea here is that in your home, when you buy a house, over time you pay off a certain portion of it. So the mortgage covers at some point, is, you know, hopefully a smaller and smaller, a decreasing fraction of what your house is worth. And so a home equity line of credit is that you take that equity on the loan, on your house, and you take that as collateral. The problem is that these are very hard to get. They take 30 to 40 days. Now on this platform, Sophie, you are able to get this, you know, process within a few minutes, and you get your funding within just a few days. So in other words, this is a way how people can refinance their loan. You can use a home equity line of credit to refinance student debt, and so on and so forth.